Hey, Tom Hegna here. I've been asked to do an update to my 2020 economic commentary. As you remember, when I gave that back in November, the economy was doing the best we'd ever seen. Unemployment was the lowest it's ever been. And of course, that's not the way it is anymore. But what I really focused on in my 2020 economic commentary is the importance of protection, that you should take some profits, that you should lock in some of those gains, and that, I would not be naked in the stock market after, 11 years of a bull market. Well, we saw why I said that, because the market has come down, and then of course now it's come up a little bit, and people are wondering, what's going on with the stock market? What's going on with the economy? Look, the stock market doesn't seem to make sense to anybody, okay? Because the stock market's going up, the economy's been going down. What's going on? Well, the Federal Reserve came out, even this weekend and said that they have an unlimited amount of money to pump into the economy. And the stock market took that as, okay, well, they're going to make sure that this market keeps going up and it doesn't go down. So, for the time being, they always say don't fight the Fed. I would say maybe you don't want to fight the Fed. But at the same time, I would not be naked in the stock market. I would put some guarantees on my money. I would use a variable annuity right now, or I'd use a fixed indexed annuity where you can get upside of the market, but you don't have the same level of downside risk. And so, I've said in the past, when people compare a variable annuity, the expenses, because the expenses are higher in a variable annuity, they're comparing it to a mutual fund or an ETF. That's an unfair comparison because those products don't have guarantees. You should really compare the variable annuity against maybe a hedge fund or, buying puts or selling stock short. And those things are very expensive. So I come back to, I can't tell you, is the market going to go up or the market going to go down? I don't know. But again, the one side of it is don't fight the Fed. The other side is, all they're doing is delaying the pain, because at some point when we print this much money, when we, come up with these trillions of dollars, they got to come from somewhere. And at some point there will be a price to pay. And at some point that market will go down, but I don't know when that is. But I do know the Japanese stock market has been down for over 30 years. The European stock market has been down for over 20 years. So don't think for a second that this U.S. market couldn't go down and stay down for an extended period of time. It definitely could. We just lived through a lost decade, and that wasn't that many years ago. So we've all lived through it. The other thing is, this isn't going to be the last pandemic that we go through. Now, any virus, any flu, anything, the media is going to blow it out of proportion, and that's going to cause volatility in the market. So I think volatility is here to stay. And at least for me and my family, I want some protection, because yes, I want to make as much as I can make, but just as important, maybe more important, I don't want to lose what I've already got. So I see interest rates staying low. I do not see inflation. People say, we printed all this money, it's got to, result in inflation. Well, Japan's printed more than we have. China's printed more than we have. Greece has printed, the Europeans have printed as much as we have. And there's no inflation out there. We're still fighting deflation. And I say this. Watch the 30-year bond. See, I can't predict the future, but the bond market predicts the future every day. And when you've got a 30-year bond at 1.3% when I'm filming this, that's telling you there's no inflation as far as my eyeballs can see. Interest rates are going to stay low. We are facing deflationary pressures, not inflationary pressures. So that's the update to my 2020 commentary. Hope that's helpful to you.